All right, so this class will be on the different types of liquidity that we have in the market and how we can take our profits in the market using those types of liquidity that we also have in the market. Now, you know that we trade liquidity-based systems. So basically, market moves from one liquidity zone to another. That is basically what we trade. So we use liquidity to get into the market when market swings an inducement and triggers your point of interest. And we also use liquidity to get out of the market also. So this class will be on the different types of liquidity that we have and how we take our profit using those types of liquidity. So you don't face a situation where you stay on a trade, market hits your actual target, and instead of you exiting the market, you don't because you don't know where to actually exit the market. Then you end up returning your profit back to the market. And also for you to know when to stay on the market for long and when to exit the market also. So that is what we're going to be discussing in this class. And the question session for this class will be in the next class. Do you understand? When we talk about directional bias. So all the questions will be together. So now we're going to start the class now. So like I said, we trade liquidity-based systems, meaning that we move from one liquidity zone to another. We rely on liquidity to get into the market. We also rely on liquidity to get out of the market. So now, the different types of liquidity that we have in the market, we have one of the most common types of liquidity, which is trend line liquidity. Now, trendline liquidity basically shows up almost everywhere, almost every pair, almost every instrument that you can think of, because trend is basically something that is fixed in the market. When market is bullish, it's going to be trending up. When market is bearish, it's going to be trending down. So it's fixed that market is going to have a particular trend. That is why trendline liquidity is one of the most common types of liquidity that you can find in the market. Because if market is bearish and is selling, it's going to be giving you lower highs and lower lows, which is what your downtrend. And the market is bullish and is buying, it's going to be giving you higher highs and higher lows, which is your uptrend. So that is why trendline liquidity is one of the most common types of liquidity that we have in the market. So it's bullish, so it's buying. It's bearish and it's selling, downtrend. Bullish and buying, uptrend. So that is why trendline liquidity is one of the most common types of liquidity that we have in the market. See, in bullish and is buying, uptrend. Bearish and is selling, downtrend. So because of that, we use trendline liquidity as one of the ways that we can take our profits in the market. Well, please, can you guys hear any background noises? Can you guys hear any background noises? Can you hear any background? You can. I'm currently outside. That's why I was just saying, let me see. How can I increase the volume? Increase your own volume. Okay. Can you guys hear me? Mhm. So, like I said, trendline liquidity is one of the most common types of liquidity that we have in the market because trend is going to always occur in the market. If the market is bullish and is buying, it's on an uptrend, and if it's bearish and is selling, it's on a downtrend. So that is why trendline liquidity is one of the most common types of liquidity that we have in the market. And we use that factor to take our profit in the market also. So what do I mean by using trendline liquidity to take your profit? Now, our market is on a particular trend, let's say an uptrend, for example, giving you a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. This is a clear uptrend. This also means that there is trendline liquidity being accumulated on the downside of this chart here. If market is bullish and is giving you a series of higher highs and higher lows, below that bullish move, there's trendline liquidity being accumulated on the downside of the chart here. Same way, if market is bearish and is giving you a series of lower highs and lower lows, 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 this is the bearish market. But that also means there is trend line liquidity being accumulated on the upside of the chart here. What this means is simply that whenever market is ready to actually reverse, that the first place the market will go to is to clear this trend line liquidity on the downside of the chart here. And if you want to reverse for this side, the first place market will go to is to clear this trend line liquidity on the upside of the chart here. What it means is that if market is bullish and is accumulating trend line liquidity on the downside, eventually if it starts selling, the nearest draw on liquidity where market will be want to go to is to sell until it sells and clears this trend line liquidity completely. That means the market will sell until it takes this low out where the trend started from. Same thing, if market should start buying, the first thing the market will do is to buy until it takes out this high where the downtrend started from. So what this means is that when market is on a trend line pattern, eventually, if market wants to start going opposite direction of that trend, the nearest draw on liquidity is for market to go and take out where the trend originated from. So there are two ways we can apply the concept of trend line liquidity in taking our profits. There are two ways. The first way is when market has been on a particular trend for an extensive period of time, then gives you a structure shift, telling you that the trend is about to end, gives you your inducement, and then eventually you get the criteria of picking your entries and you pick your right entries. That is one of the ways. What I mean by that is, for example, let's say you have an extensive uptrend that for a long period of time, market has been bullish. So it's been giving you higher high and higher low, 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 higher high. And so for a long period of time, market has been bullish. And all of a sudden, this happens. When this happens, this means what? A market structure shift. This is basically telling you that, yes, I was previously on an extensive uptrend and I was bullish for a long period of time, but I'm already exhausting this trend and I'm about to reverse to the opposite direction. That is what this market structure shift means. After that, the next thing that should come is your inducement, meaning the market should give you what? A pullback that still proceeds to take out the closure of the MSS candle. This is your inducement. With the rules of picking a point of interest, your POI would be this breaker block here. So that means that eventually you're expecting market to what? Sell from this zone. So the entry has already been gotten, but it's now left for the take profit level. That's when you can now observe the chart and see what pattern was market on previously before this structure shift occurred. And if you check, you can see that market was previously what? On an uptrend. And this uptrend is what? Made up of what? Trend line liquidity on the downside. What that means is that now the market already gave us a structure shift and it means the market is about to reverse to the downside, the nearest draw on liquidity for market is to go to where the trend originated from and then take it out. And from the looks of things, the trend originated from this downside here, meaning that if you take a sell from up here, this breaker block, our take profit level will be where this trend originated from, which is down here. So this is what market is going to do. It's going to sell until it completely clears this trend line liquidity. And now the mistakes that most people make is what? Trying to now buy from POIs that are enclosed inside of the trend line liquidity. Because obviously all these lows here are other blocks. This is an order block. This is a breaker block. You see an order block here. Now, the mistake that most people make is that, yes, they see the market has been on a particular trend for a long period of time. Yes, the POIs would have held, but market already gave a structure sheet telling you that what market is about to change directions to the opposite side. What that means is that market is going to become bearish until it clears the nearest draw on liquidity. Now, any point of interest that you have enclosed inside of that draw on liquidity, that is any point of interest that you have enclosed inside of this trend line liquidity, market will most likely not respect it. So what it means is that all these other blocks that you have here for buys, the market is not going to hold from them. The market will keep selling and selling. Maybe it will come here and then push up a bit and then trigger another sell. Come here again, push up a bit and then trigger another sell. come here again, push up a bit, and then trigger another sell from here. But any of these POIs that you see here, market will not respect these POIs to what reverse the market direction to the upside, provided that the market direction already shifted to the opposite side, and the nearest draw on liquidity, which is a take profit level, will be for this trend line liquidity here to be swept. Are you guys following me up? Okay. So, so that is so the mistake that most people make is that when market is already shifted structure to start going to the opposite side, they keep looking for like trades in that same direction to the market was previously on before, forgetting that market already gave a structure shift and the take profit level would be where the trend originated from. So, for example, now you can see this gold trade, you can see this extensive uptrend the market was previously on. I'm going. Something. Now, market was previously on an uptrend, giving us a series of higher highs and higher lows, higher highs, then 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 higher lows, higher highs. If they instead of making another higher low to continue pushing up, hang on. You guys wait. You guys, hang on, give me a minute, please. All right, I'm coming. So let's continue, please. Something was distracting me. So now, like I was saying, whenever market is on a particular trend, it's going to be very obvious. If it's a downtrend, you will see a series of lower highs and lower lows. If it's an uptrend, you will see a series of higher highs and higher lows. Now, there are also zones that we expect reversals to come in. Mind you, I said that it's not every place you see the market and you're expecting a reversal to come into the market. There are zones we expect reversals to come in. So, for example, let's say like a higher time frame zone that we've already marked out, and before price approached the zone, then it was like on a particular trend, higher high, higher low, 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 higher high, higher. Then it hits that zone. Then all of a sudden, after hitting this zone, it takes this low out. This is an MSS, and then a proper one at that because market hit a zone on the higher time frame where we're expecting a reversal to come in. After that, you expect your inducement. Then, with the rules of picking a point of interest, the nearest point of interest would be up here now, which is this OB. So, meaning that you're expecting a sell to happen from this zone. But the main thing now is where your take profit level is going to be. Now, if you observe, the previous pattern that market was on was what? An uptrend, telling you that what this is what trend line liquidity on the downside of the chart. It means that eventually when market becomes bearish and they start selling, market is not going to stop the sales until it goes to where the buy the trend line liquidity originated from and clears it. Meaning that if you take a sell from this other block, your take profit level will be aimed to down here. So this is the a perfect example here. Understand? A perfect example here. So there are zones that we expected the reversal to come. When I talk about directional bias, you guys will understand the zones I'm talking about. So this is an OB here on the. So we're expecting a sell to come into this zone in the market. So the market kept giving us these higher highs and higher lows. We knew that at this level, we would expect a reversal to come in. And the only thing that can confirm that reversal is for market to give us what? An MSS. Now, when market kept maintaining this uptrend, good and fine. But when it hit this level, what happened next? Market took out the last low that was made before this high, giving us a market structure shift. Now, when I talk about directional bias, you guys will understand these zones I'm talking about. But this is an other block on the 45 minutes time frame that we're expecting a sell that like market can give us a reversal from. But the only thing that can confirm the reversal is what the MSS. Now, when markets gave us hit this level, what they did not continue pushing above it. It gave us an MSS instead, meaning that we've gotten a reversal concept. After that, price gave us what a pullback before continuing pushing back down to take out the closure of the MSS candle, in that this is a proper inducement. Now, when market gave us this MSS and the candle closed below here, you have to look upwards to find possible points of interest. So what? This low that was taken out, the body of the low will become a breaker block, and up here will be the other block that triggered the move to happen, meaning you have breaker and then OB as an entry. Now you have your proper inducement. Now you have your proper inducement. After that, the third rule should be to look for the points of interest that are still unmitigated. But market was giving us the inducement. It did not touch this breaker, neither did it touch this other block, meaning that two of them are still valid entries. And the last rule means that you should take the point of interest closest to your inducement. And if you check, this breaker is the one closest to our inducement. That's why we're picking our entry from what? This breaker block. So you're picking your entry from the body of the breaker, and the stop loss will cover the entire breaker block candles, which is what this bearish one and then this bullish one. This is where our stop loss is going to be. This was the trade entry and the hit. Now, for our take profit level, we will now observe what pattern was market. Can you guys hear me? Now, if you observe the market, you can tell that there was a previous uptrend that market was on, which is what this. And now we got market hitting a higher time frame zone and then giving us an MSS after it hit that zone, telling us that the structure is about to change. Now our take profit level will be aimed at where the trend originated from, which will be all the way down here. Meaning that if you should take this sell, your take profit level will be all the way down here. Meaning that all these POIs that you see that are enclosed inside of this trend line liquidity, see this OB, see this breaker, see this breaker, any point of interest, provided that it's still inside of this trend line liquidity, don't try and use it to buy. Markets will maybe give a bit of reaction there and then fail eventually. You understand? So you should just focus on looking for sales until market successfully what clears this trend line liquidity. And just to show you guys this was around May because I took this same trade. I want to show you guys the trade. This was the trade here. Can you see? The structure shift, inducement, entry at the breaker, my take profit level at the trend line liquidity where it originated from. This was when the trade, this was my second, I'll show you guys the second entry, but this was when the trade hits full take profit. So I did not panic to close my trades or start looking in the opposite direction to trade because I knew where market was going to. And the only way I was able to know where market was going to was because I understood the concept of liquidity. So I knew that for market to be on a particular trend is accumulating trend line liquidity on the opposite direction. And if market should change structure, the take profit level would be where the previous trend originated from. So instead of looking for trades in the opposite direction of the market, I'm going to focus on what? Looking for trades in line with the current direction of the market to where the trend line liquidity is. Until I successfully clear that trend line liquidity, I am not going to oppose the market direction. I'm going to just be looking for trades in that same direction. Are you guys following me up? So now the more that market now as you're trading, provided the market has not yet successfully cleared that trend line liquidity, you don't try to oppose the market direction. You just keep looking for trades in that same direction of the market. Now, another entry again, we have market words giving us, we have market words taking out. Now, remember, MSS is for first time reversals. We already got our entry. So, moving forward, if you're looking for more entries to join the sell, we're going to be using what? Continuation entries. And continuation entries is what? Gotten with double or multiple breaks of structures. So, the moment that price took this low out, plus this low here, even this one here, we got multiple breaks of structures. So we have gotten that the second rule is to look for your inducement. Now, our inducement, the first valid pullback after an MSS or a double break of structure. So when market gave us this pullback, that is this candle wick, and they proceeded to take out the closure of this double break of structure candle, we got our inducement. Now, the third rule, the point of interest needs to be unmitigated. When market was giving us inducement, it did not touch any of these POIs, meaning that all these POIs are still valid to be used as entries. Now, when market gave us double break of structure, the body of this becomes a breaker, the body of this becomes a breaker, here becomes a breaker, and here is the other block zone up here. So you have multiple POIs, but with the rules of picking a point of interest, you've gotten a double break of structure, inducement, check for all mitigated ones, then finally pick the one closest to your inducement. So if you're tracing all these POIs, the one closest to our inducement is what? This is the first one. This is the second one. If you're tracing it, the one closest to our inducement is here. So this is where our sell would be from this breaker block here. Then our stop loss will cover the candles of the breaker, which is what? This bearish candle and this bullish candle here, which is this. So this is where the second entry would be, the continuation entry. Then our TP will still cover the trend line liquidity. So provided the market has not yet what clear the trend line liquidity, we are going to focus on looking for more sales. Now, this second entry, I also took the second entry here. So this was the first entry. The second entry was right. Wait. The second entry was here. You can see the when mm, so you can see the second entry when it hit. I entered later because I was not active when it triggered, but this was the second entry when it triggered the second entry. The same thing, double break. Remember, first time reversals, MSS, more continuation trades, double break of structure. So the double break of structure, the first entry, we got it. That is his first entry here. Is it? Yeah, here. Second entry here, and then it hits full take profit letter. This was the first entry I got for the sell. Then this was the second entry I got for the sell also. The second entry. So it hits 120K when it hits full TP next week, but I don't have the screenshot. So the thing is, once you know the direction you are trading at, the trend line liquidity already tells you that you are not supposed to be looking for anything other than sells until market clears that trend line liquidity. What it means is that you should focus on looking for continuation trades until the trend line liquidity for the TP hits. So that is basically the mistake that people make. They will see market on a particular trend, market shifts structure. They don't know what their take profit level is supposed to be. They start looking for buys with every point of interest that they see enclosed inside of those zones. They will keep hitting stop loss until market successfully goes where it's supposed to go. So, like I said, there are two ways we use trend line liquidity. This is just one of the ways. When market is on a particular trend for an extensive period of time, then hits a zone where a reversal is meant to come in, gives you that structural shield to your inducement, and you pick your right point of interest. Your take profit level, you target where the trend originated from. That is one of the ways. Understand? So it's something like this also. It's also something like this. You can see this downtrend, this long downtrend here. Market was bearish, giving us lower highs and lower lows. This zone that this buy is coming from right here is what a daily time frame breaker. Like I said, when we talk about directional buyers, you guys will understand the zones I'm talking about. But if you check, for example, the zone that we're talking about here is a daily time frame breaker block. Let me mark the zone out. This is the zone here. Daily time frame breaker block. So the market hit that zone. I know that I was already expecting a reversal at that level. So what I would do is to wait for market to give me a structure shift, inducement, and then my point of interest. When it happens at this level, can you see this was the zone? The market triggered the zone, it now gave us the MSS and then triggered the point of interest and then started buying. Now, what I would do is I've already gotten my buy POI. The next thing in my mind is where market is heading to. Now, if you observe the previous pattern that market was on before our point of interest, before this reversal zone triggered and market shifted structure, you will notice that market was on a downtrend. What this means is that this is what trend line liquidity all the way up here, meaning that market is going to be bullish until it clears this trend line liquidity, especially because market already triggered the zone on the higher time frame where a reversal is meant to come in, and at the same time already got a structural shift. What it means is that we're going to buy until market clears this trend line liquidity. Any sell zone that you see here, don't take it. If market hits a sell zone, it's going to be a temporal sell to trigger more zones for market to move in your direction. So market is going to be bullish until it buys and successfully what clears this trend line liquidity up here. And that was what market did. Exactly. The market did not take out this low until it bought and cleared this trend line liquidity here. I got my entry on the 4 hours time frame, and I will show you guys the trade also. That was the buy that made the all-time high on gold, which is here. I'm coming. Um, this is the buy here. So if you see, this one I first marked out is the daily time frame breaker. Then I got an entry from this OB as the confirmation, as the MSS. After that, I targeted the trendline liquidity. This is the 4 hours time frame, so you can't really see trendline liquidity clear, but here is very, very clear here. So that was how I bought. I took this trade. I held it for 3 months. Like I was looking for buys for 3 months until market cleared that trend line liquidity. But this was the first entry. You can see your market was still moving. I got more entries until eventually market hit the full target around. I've forgotten when the target hit, but let me see if I can find it. I think it's around um I'm trying to see the data. Okay, this is it here. I saw market bought all the way. So I was not skeptical about trading against the market direction or anything because I knew that market hit a zone for reversal, gave me a reversal concept, and the take profit has to what sweep the previous liquidity or origination. So I was actually trading in that direction until market hit it. I did not hold one position for 3 months. I was looking for trades to sweep the trend line liquidity, meaning that I was just focused on looking for only buys until that trend line liquidity got taken out. So that is one thing. That is one way you can apply the concept of trend line liquidity. That is one way. But this way is not really that common because this way mostly works with just reversal concepts. You can only use this way with reversal concepts where market is on a particular trend, then decides to reverse and change structure. That is when you can only use this way. There's also another way that you can apply to any concept, both reversals and both continuations. And I'm going to talk about that next. I hope you guys are following me up, please. So that is one of the ways that that's one of the ways that you can apply trendline liquidity, but this is just for reversal concepts. Now, aside reversal concepts, you need to also apply take profit levels for continuation concepts and the rest. And then you can also apply the trend line liquidity there also. But how you can apply it is that in reversal concept is when is on a particular trend for an extensive period of time, then you wait for a reversal to happen there by getting an MSS. For continuation concepts or for other concepts, you can just wait for price to approach your point of interest, then monitor the pattern the market is giving you while approaching your point of interest. You can use that to determine your take profit level. For example, let's say you're trading a continuation trade, and let's say market already gave you an MSS. They already gave you an MSS and it's already buying. You understand? It's already buying. And then it does something like this. Let's say double break of structure, taking this high and this high and this high. After that, it gives you inducement, then pushes up. So normally, this is your inducement. Your entry will be here, but there's no pre-existing trend line liquidity for you to target. So what market will do is that before it approaches this point of interest, it can start doing something like this: lower highs, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower. Then it's going to trigger your point of interest. And this is the second way you can apply trendline liquidity, where market approaches your point of interest in a trend-like manner. This can now work for reversals. This can also work for continuations. Once this happens, you can observe the chart and see that market was what in a trend-like manner when approaching your breaker block. This means that if you should take your buy from this level, the take profit level will be where the trend originated from, which would be up here. Meaning that you should not look for anything sells until market successfully what clears this trend line liquidity and takes it out. So this is one of the most common types of using trend line liquidity, one of the most common. For example, here we have a breaker. We already have MSS, market is already buying. So to look for more entries, you're looking for continuations. So when this high, and all these highs, they go taken out, you've got multiple breaks or structures here, here, here. After that, this week here is your inducement. And then market is coming to target what a breaker block here. So while approaching the breaker block, you can see that there was no pre-existing. Let's even say we're ignoring this trend line liquidity on this left side here. But if we check, where market was now coming to trigger this breaker block, it started giving us what? Lower highs, lower low, lower highs, lower low, lower high, lower low, lower high, lower low, until it trigger this point of interest. This is what a downtrend, trend line liquidity. What it means is that if you take a buy from this breaker, your take profit level will be aimed at what? Targeting where this trend originated from for your point of interest got triggered. This is here. This will be your take profit level. You understand? Even here, remember, looking for continuations, you're always looking for double break of structure. But market took, you can see this high here. Try to take out this high, did not work. So it's now two highs, this and this. The market took this zone and this zone, that's double breakout structure. Then market put down, gave us inducement before pushing back up is our inducement. Then the rules of picking a point of interest, mark out the mitigated zones. See, this one is already mitigated. This breaker was mitigated, but market was getting inducement, so it's disqualified, leaving only this other block for our entry right here. Meaning that our entry will be from this OB and the stop loss at the bottom of the OB down here. Now, for our take profit level, if you observe, the market was approaching this our OB, started giving us what lower highs, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So what downtrend, trend line liquidity right here. Meaning that if you take our trade here, our take profit level will be aimed at where the trend originated from. It's going to be all the way up here. So trendline equity for take profit, trendline equity for take profit, same trades. Um, I took. I'm gonna find out when I took it. Price action has been shit lately, so This is the trade right here. So you can see the first one, second one. That this was the double break of structure inducement OB. Well, market was approaching my entry. I kept my take profit level here initially, but when I spotted the trend line liquidity, I had to now adjust it to the trend line liquidity, as you can see. I had to adjust it there. So this was when I had analysis. My take profit was here initially. My market made the trend line liquidity. I had to adjust my take profit level to the trend line liquidity. That was how I took my trade until market hit the trend line liquidity as my take profit level. So one way is for just reversals or markets on a particular trend for an intensive period of time. You have to get a reversal concept to now confirm that market is going to go and take out where the previous trend originated from. That is one way, but it's not that common because reversals happen few times. But the other way is one of the most common, the one that market is or will be approaching your point of interest, but it will do so in a trend-like manner. Another way, that's the same thing here. There's what market being bullish, taking out this low, giving us our MSS, giving us our inducements. But then there's a breaker block here that market is supposed to sell from. That's what the rules of picking a point of interest. Our sell is supposed to come from here. Now, one thing you notice, but markets made all these moves, so it's going to be difficult to pinpoint a take profit level. But before market approach the level, they take profit. What they start doing, start giving us what highs, higher low, higher high, 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 higher low, then trigger the point of interest. Already, one triggering the point of interest, it already gave us what? This trend line liquidity. Meaning that if you take our sell here, we're not supposed to look for anything buys until market use that trend line pattern that it was on before the point of interest got triggered. And that we're going to be bearish until market use this what trend line liquidity. Like I said, this is one of the most common types of ways to use trend line liquidity because the market approaches a point of interest in a trend line manner, it's more convincing that that PI is going to hold. You understand? When market approaches a point of interest in a trend like manner, it's more convincing that that point of interest is going to hold. So that is one of so it's very, very common on the chart. It's very common. If you look at your chart, you will see trend line liquidity almost everywhere. Here, this sell, this buy from this breaker, markets approached it with a trend line liquidity pattern. Market bought, so the trend line liquidity. If you check your chart, majority of the time that price approaches the point of interest, it does so in a trend line manner. And if you approach it with a trend line manner, market will clear that trend line liquidity as your take profit level. So that's just one thing with this. Even here, there's a breaker block here on gold, 1 hour time frame. Before market approached the breaker block on gold, started giving us what this downtrend, lower highs, lower lows. I marked it out here. When it approached it, it hit it and then gave us an MSS inducement and then what a reversal concept to trigger this breaker. Yeah. Meaning that once the buy starts, market to buy until it successfully clears this trend line liquidity that market was on before the breaker block triggered. And that was what market did exactly. So that is this is one of the ways you can take your profits in the market. So trend line liquidity is one of the most common types of liquidity in the market simply because market is always going to be on a particular trend. If market except it's ranging, which is also why we also have what we call ranging liquidity, but we're going to get into that later. So markets will always be moving in one direction. If either is bullish or is bearish, either is bullish or is bearish. So if it's bullish, it's going to have an uptrend, meaning that it will have trend line liquidity on the downside. And if it's bearish, it's going to be a downtrend, meaning that you have trend line liquidity on the upside. So that's why trend line liquidity is one of the most common types of liquidity that we have in the market. And that is one of the most common types of liquidity that we have in the market. And that is how we can take our profits in the market using trend line liquidity. Now, it does not matter the time frame you're on. It will show on any time frame. Do you understand? It does not matter. That's why I said time frame does not matter. If you're on the 15 minutes time frame, you will see a 15 minutes time frame trend line liquidity and you target it. Regardless of what you trade, you will see, regardless of the time frame you trade, you will see it on that time frame. Even 1 minute time frame has trend line liquidity. You just have to target the 1 minute time frame trend line liquidity. So that is one of the most common types of liquidity we have in the market. That is trend line liquidity. Now, after that, there's another type of liquidity that we have in the market, which I also use to take my profits in the market. The second one, well, I want to talk about this, but it's not really that common. I've not seen it on the chart for 2 years now. The last time I used it was in 2023, I think. But it's what we call equal highs and equal lows liquidity, which I can't really. Oh, but hang on, someone is knocking on my hotel room. Oh, sorry, someone the cleaner was knocking at the door. So, like I said, what we call equal highs and equal lows liquidity and types of liquidities in the market, but it's not really that common because the last time I traded it was in 2023 or 2024. Basically, when market makes a relative equal high or equal low, um, that is what we call equal highs or equal lows liquidity. Most people call it double bottom or double top, but it's actually a type of liquidity. It's basically something like this: when market gives you a high, then fails to break above this high, but makes a high so like the same level as the previous one, same high. This most people call it double top, but it's not. It's actually a type of liquidity and it's not equal high. And this is very, 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 it's not common. In fact, I've not seen it in 2 years. That's why, but I still want to teach it. But it's actually a type of liquidity in the market, and you can also use it for your take profit levels because whenever there's liquidity in the market, prices will always want to sweep the liquidity. So, for example, let's assume that you have like a buy POI down here. Let's say, okay, let's just say something like this happens. Yeah, you get this inducement, the market pushes up. Then during the wrap process, it gives you an equal high liquidity. Then while coming to trigger your point of interest, you're skeptical for where your take profit level would be. No need to worry about that because there's what equal highs liquidity. It means that if market should take a buy from this OB, the take profit level will be aimed at where this equal highs liquidity is because markets is attracted to liquidity and markets will always want to sweep liquidity. So because there's trend equal highs liquidity here, markets will not make any kind of reversal to the downside until it successfully clears this equal highs liquidity. Market is attracted to liquidity. You understand? The same way you're attracted to big bomb. That's the same way that markets are attracted to liquidity. So markets always want to go to where there's liquidity in the market. So there's no point of interest here now. For example, there's this zone now, the breaker. Most people will start selling from this zone. It will never hold because there's liquidity up here for market to clear. So because of that, market will keep buying and buying until it takes out this high. That is how to trade equal highs liquidity. But it's not. I've not seen it on the chart for 2 years now, so it's not really that common anymore. Same way for equal lows liquidity. Let's say something like this happens, inducement, then pushes down, then does something like this. Let's say equal low, then pushes up. Then you expect to sell from the OB level here. The market trigger this zone. The place you expect market to go to is this equal low liquidity right here. Meaning that we expect market to take out this low here. Because that is nearest drawn liquidity. So any point of interest you have, maybe like a breaker block here or a breaker block here, market is not going to hold and buy from any of these POIs because there's equal lows liquidity right here, meaning that market is going to sell until it successfully what clears this equal lows liquidity here. So it's going to ignore every other POI here that's supposed to reverse the market. Do you understand? So that is one of the types of liquidity that we have, which is equal lows liquidity. Oh, people keep interrupting me. I'm coming. I'm sorry, I'm outside. People they interrupt me, but don't worry, we're about to round up very soon. Hope you guys are following me up. So that is just the concept of equal highs and equal lows. It's not that common. It's just basically when market makes an equal high, the same level high as the previous one that they made, the market will always come and sweep it. So it's just certain that the market will take out the equal high or the equal low, but it's not really that. I can't find it. Like I can't find it on the chart. For the past 2 years, it's not on the chart, so it doesn't really show up again. But it's a type of liquidity just for knowing sake. Now, the other type of liquidity that we have in the market is called ranging liquidity. Now, ranging liquidity is mostly for when market actually does not trend. Most times when market is just consolidating, and it's mostly for slower pairs. All these pairs like NZD, CHF, or NZD card, all these pairs that range a lot. All these volatile pairs like GP, USD, gold, and the BTC, the rest, they mostly trend and they don't really range like that. So when market, you see pairs that range a lot, we apply the concept of ranging liquidity there most times because they tend to actually be fixed at one point for a long period of time. Pairs like, let's say, I think this pair, NZD card, there's a trade, uh NZD can now see what market does. When it's ranging, it's basically a range basically means market moving from two fixed points. So it's basically going from like support to resistance, resistance to support, support to resistance, resistance to support, support to resistance, resistance. So this is what a range is all about. Another name for it is called a consolidation. So a market is ranging. That's what market is doing that most people don't know. It's accumulating liquidity on both sides of the chart. The downside is called sell side liquidity, then the one on the upside is called buy side liquidity. What market does is that it's going to keep ranging until it's ready to what to break out of the range. Now, when it's ready to break out of the range, what it will do is that it will go to the direction where market is not is the opposite direction that market is going to go to. That's where price is going to go to first and sweep liquidity there. So, for example, let's assume this is what market does. Let's say you have a structure shift to the downside. The market gives you inducement, then pushes down, then starts ranging. While ranging, you have buy side liquidity up here, and you have sell side liquidity on the downside. This will be the point of interest you're expecting market to come to. Market is going to keep ranging for a long period of time until it's ready to break out. Once it's ready to break out of the range, it will go and sweep the liquidity on the upside first because it's meant to go to the downside. Once it sweeps that liquidity, it will trigger your point of interest. When that point of interest triggers, market is going to go and take out liquidity on the other side of the chart. So, for example, if market comes here and sweeps this ranging liquidity for the buy side, triggers this other block, the zone that market is going to next is down here to take out the liquidity on the opposite side. That's an example of ranging. So that's an example here. NZD card, MSS, and it started ranging. This is the other block on the 4 hours time frame. It kept ranging until it's ready to break out. The moment it's ready to break out, you sweep that liquidity on the upside because it's meant to go to the downside. trigger the 4 hours OB, and then sold. Now, if you have no idea of where market is supposed to go to, you would ignore this range. Most people will keep their TP all the way down here. Now, pay attention to what market did. Immediately it swept the range, came out, take out the one on the opposite side. What did we bought? So had it been that you're holding the trade, you would have hit stop loss. So it's very important to understand the different concepts of liquidity because it will help you out a lot. It will help you out with having been in profit and losing everything back to the market. It will help you out to know how long you should hold a trade. Now, most people would have been so skeptical when market keeps, dropped here, came up again, dropped here, came up again. They're going to be skeptical because of the whole pullback and the rest. Some may rush and close their trades. But simply because you understand the TA and you have confidence in your analysis, because it's knowledge that backs up confidence. Knowing that ranging markets will not break out of a range unless it sweeps both sides. It's already swept the one on the upside and triggered the OB. It must sweep the one on the downside. So no matter the kind of pullback it does, it needs to take out the range on the opposite side. Now, any point of interest that you have enclosed inside of a liquidity pool, don't try and use that point of interest to reverse the market. So the market is already selling to take out the other range of liquidity. There's no point looking for buys from OBs here or another OB here or an OB here, provided that all of them are inside of the ranging liquidity. The only point of interest that you can look at is one that is outside of the ranging liquidity. Same way for trendline liquidity, you don't look at any point of interest inside the trendline liquidity to reverse it. It's the one outside of it. So any point of interest enclosed inside of the ranging liquidity, trendline liquidity, in fact, any type of liquidity zone, don't try and reverse the market direction with those points of interest because it will not hold. So this is one type of liquidity, which is ranging liquidity. Not that common. I would say it shows up 20% of the time or 30% of the time. But trendline liquidity is very, 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 very extremely common on the charts. That's why we check, for example, this is the OB trade, the inducement. Now our market is approaching our point of interest, which is the other block. It was doing so in a trend-like manner, giving us what? Higher lows, higher high, higher lows, higher high, higher lows, higher high, higher lows, then triggers what? The OB. Now what market will do is to what? Target where the trend originated from before the point of interest got triggered, which is what? Down here. That's why our market sold. It sold all the way here. Even this one, same thing. Trendline liquidity, or market sold all the way and took out. So this is even here, breaker block on the 4 hours time frame inducement. Before price approached that level, it was in a trend-like manner. The market triggered the zone, the breaker, it sold until it cleared that trend line liquidity. So this is one thing you guys should understand. Trendline liquidity is very common. One of the most common types of liquidity. Like I said, two ways. First way is only just for reversals, where market is on a particular trend, then hits a zone where it's meant to reverse, gives you your structural shift inducement and your point of interest. Then you use the use of picking a point of interest to get into the market and target where the trend was previously on to take your profits in the market. Then the second way is when market already has a point of interest. You already have a point of interest. Then when market is approaching that point of interest, it does so in a trend-like manner. That trend-like manner will tell you where to keep your day profit level in the market. Hope you guys are following me up. There are a lot of distractions coming in. Are you guys following me up? Now this is the final way for take profit level. This is actually the nearest, the easiest draw on liquidity in the market. It's basically targeting the last high or the last low in the market before your point of interest gets triggered. If you don't understand, just watch the recording and any questions you have, you bring it on the next class that we have. You understand? So this is the easiest way, targeting the nearest drawn liquidity by targeting the last high in the market or the last low in the market before your point of interest get triggered. What I mean by this is very simple. Let's say this is like a double break of structure here. Market gives you inducement, pushes up. You understand? Then this is the last high in the market. While coming to trigger your point of interest, if it triggers it, the last high in the market is here. Nearest drawn liquidity must go to that nearest high. This is the easiest way to take your profit. The last high, the last low, market will always get there. If you check, it even works hand in hand with other types of liquidity. This is the last low in the market before our point of interest got triggered, but it's still in line with trendline liquidity. You can either apply the concept of trendline liquidity or still apply the last low in the market before your point of interest. I'm back. Can you guys hear me? Yeah, I just came back now. Someone was knocking. So, what I mean by that is if you have a POI and before market triggers the POI, the last high or the last low that was made in the market before that point of interest gets triggered can be the nearest drawn liquidity that you have. For example, even this OB that we have here on the 4 hours time frame, the last low that was made before that OB got triggered, the last swing low was down here. So even if you don't target the nearest, like using range, you can use this last low that was made before market started pushing up to trigger your point of interest as your take profit level. It still matches the ranging liquidity and at the same time matches the last swing low in the market before your point of interest got triggered. In fact, if you don't see any other types of liquidity in the market, you can apply that concept. If you check and you don't see trendline liquidity, you only see trendline liquidity. But if you don't see trendline liquidity and you don't see the rest, you can apply that concept, the last swing high or the last swing low, because check it, markets will always go to the last high that it was. It wasn't. So for example, market makes a high, then comes to make a retracement. That high that was made, market will always go to it, or the low or whatever, market will always go to it. For example, the buy that happened here, this OB, this what? This is an MSS inducement OB here. Now the last high that was made, the last swing high was here before price started coming to trigger this OB here. And when it triggered, what the market did, it bought until it what? First place it went to that high. Understand? This was the last swing high before market came down here to trigger this point of interest for a buy. When it started buying, what the market do to the high? Last swing high right here before price came to trigger this zone. When I started buying, what the market do? That high. You understand? So the last swing high or the last swing low in the market before your point of interest got triggered. See it again. Point of interest here. Last swing high was where? Here. Before market triggered the point of interest. Once it triggered the what the market do? That high. That is the nearest drawn liquidity. That is where markets will always go to first. Just that it has lower risk to reward ratios. But anyone trying to be on the safe side, that high there, the first place that markets will go to. The high or the low, depending on the direction of the market, that is where markets will go to. That's the first place that markets will go to. This is the what? The low. The last swing low. If our market came to trigger the point of interest here for a sell, once it triggered, the first place the market went to, that low. It dropped lower, but the first place it went to was that low. You understand? So that is just the concept of liquidity. The nearest drawn liquidity, the last swing high, the last swing low that markets made before your point of interest got triggered. But you can also apply the concept of other types of liquidity. Even this one, this is what trendline liquidity, but it's still the last swing high that market made before coming to trigger our point of interest. And that was where markets went to, the high. Even here, this is trendline liquidity, but it's still the last swing high that markets made before coming to trigger this breaker, and that was where markets went to, the high. So this actually works with other types of liquidity as well. I can also apply it in the market. But just to be safe, the most common type of liquidity that you see in the market for your take profit level will be trend line liquidity, because the market is always moving in one particular direction. If it's trending up, it's trending up. If it's trending down, it's trending down, except it's ranging. So that is the different types of liquidity that we have in the market. I know you guys have a lot of questions, but that will be in the next class. I've already tried today with the question, and I've already tried with the second class, with the two classes in one day. So you just rewatch the class, and any questions you have next class, just bring it to the stand. So this is just it for the different types of liquidity that we have in the market, and this is also how you can take your profits in the market. Hope you guys understand. I'll open the WhatsApp group this night. It's supposed to be after we are done with classes, but I'll open it this night. So